So the question of the day, what did you make of Jay Powell's comments? How does it shape your view of the equity markets for the rest of this year?
Yeah, Frank. I mean, it's almost a tale of two halves, right? When you had the prepared remarks, it was kind of dovish. And honestly, the whole statement we'd say was slightly more dovish. I mean, Fed fund futures dropped for a hike in November and dropped in December from 40% down to 25%. But we're fully aware. Then there was Q&A. They asked him, hey, are things tight? And he said, maybe it's not tight enough, almost running counter to what the prepared remarks were said. But it is what it is. We saw the reaction, obviously, in yields like he just showed. Now, the good news, we are beneath 5% now, but I am fully aware that can change quickly. So I'll put it this way. We're about flat for the S&P in October, right? You look historically, October can be kind of rough. Usually by the second half of October is when things get better. I'll just put one final comment on this. Yesterday, initial claims coming under 200,000, right? We've seen a lot of positive economic data. In our opinion, that's one of the main reasons we've had these higher moves in yields, because the economy has been so strong. And we are still in the camp, Frank. We haven't changed our opinion. We don't think the Fed's going to hike anymore. We think the Fed's likely done. I know the reaction in yields yesterday, but again, the prepared remarks kind of were in line with what some of the other previous Fed members have been saying, which again is the higher yields have done a lot of the Fed's work here.
You know, it's so interesting you say that right now. I want to play this clip for you. This is also Jay Powell. Again, we saw the bond market rise very briefly when we talk about the 10-year, that yield crossing 5%. I want to get your take on Powell's comments on bond yields and the impact of the overall economy.
The whole idea of tightening policy is to affect financial conditions. And to the extent higher bond rates reflect that they do, they're producing tighter financial conditions right now. So that's how monetary policy works. That's literally how it works. So, again, in principle, as long as bond rates are going up for some reasons, and they're not going up just because they expect us to do things, so that if we don't do them, they'll come right back down. And we don't think that's the case. Actually, I don't think it's the case.
How did you read those remarks by Jay Powell? I was actually doing halftime report at the New York Stock Exchange yesterday. I talked to a couple of traders, also a couple of portfolio managers. They just said that was just kind of muddled. They weren't really sure what to make of it.
Well, I'll be honest, I was kind of thinking the same thing when I saw it live and listening to it there again. I mean, that's kind of the Fed's job, is to talk and almost confuse us all, I feel. But again, I mean, he's talking at the same time that, listen, higher for longer is here. I mean, look at what, again, the Fed fund futures are saying. We've been in that camp for a while. We don't think, we've said all year there'd be no cuts this year. But at the same time, we don't think they're going to hike. So it is a little bit of a mixed bag. But I'll be honest, Frank, again, higher yields aren't a shock with the economy strengthening like they are, but we do feel optimistic that 5% clearly is a big psychological level. Maybe we could be nearing some type of a potential peak in yields here, which wouldn't be abnormal when you look at kind of some of the over-the-top negative sentiment that we're seeing. People are kind of becoming very, very pessimistic on bonds as well. I mean, TLT, we've seen it, almost a worse sell-off now than we've seen in history for stocks.
Ryan, I want to come full circle. So again, now that we know where Jay Powell stands, we have some sense of direction of where the Fed wants to go. What sectors are you looking at? Where are you seeing opportunities?
Yeah, we've liked the cyclicals all year, Frank. We're still in that camp. I mean, industrials and energy have been two of our favorite sectors. Relative strength, energy's been the leader. We all know that. But industrial is starting to show some leadership. I'll say we're more neutral financials, but one thing that, if there's anything encouraging for the bulls out there, we have seen some strength coming out of the large financial companies all of a sudden. I know earnings were last week, so that's a potential thing to be aware of. And the other one that I know people don't like a lot, small caps. We do have a slight overweight to small caps, and I'm aware of the weak action that we've seen. But I'll tell you, Frank, if you think we're closer to a peak in yields, like we think we're getting there, with the Fed likely done hiking, with the economy, in our opinion, that is still on fairly firm footing, small caps look good. And then one final comment: if you look at forward PE multiples, small caps are historically cheap relative to large, so it's one of the cheaper areas out there. So that's an area we like, small caps and cyclicals still.